But nonetheless, on another element with regard to investment outlooks for 2017, and hopefully this time we have a little bit more control over this than what robotics do. Earlier today I spoke to Donnie Venter, who's advisory partner at Citadel, for a sector-by-sector outlook discussion for 2017.
I think 2017 is going to be a very interesting year for the South African investor, specifically given all the different approaches to investing, active and passive side of the markets. We see passive has come to the market and to the fall. We've seen it in media. A lot of people are very eager to it. And then a lot of the questions we face as wealth managers is why pay an actively managed unit trust portfolio when a passive solution does the same job or similar jobs than to the active returns that have been generated. But again, you have to look at the bigger picture. Diversification of portfolio construction, etc., and other means.
Very true. On that active versus passive debate,
yes,
though, many might say that passive hasn't performed too well, given that markets across the board, and in particular South African markets, were very muted last year.
Yes, no, it was a muted market. I generally prefer looking at the long-term averages because I feel the market is very skittish. I mean, a lot of the asset managers are actually referring to Twitter to see what are the tweets posted by Trump and his politicians to see how they can adjust the portfolio to shave some profits off the top. But it's a very skittish market we find ourselves in. We know over a 5-year term, the South African market, this is up until Friday last week, did 12.7%. Global markets, the MSCI World Index, about 10.6%. SA-listed property was the blue-eyed boy for many, many years in the South African market, doing just shy of 17%. SA bonds just above 7%. And the cash side is then 6%. But each element has different tax consequences. Each element included in the portfolio is included for specific reasons, diversification being one of them.
Coming back to that element, and maybe let's focus on equity, both South African and offshore, for a moment. We know that the macro elements are certainly Trump being elected. We're looking at rising interest rates coming through from the US. And of course, we can't ignore China.
Yes, China is a very interesting debate. I think you can never ignore 1.1 billion people. That's the last number I heard. So I think it's a very important market. But then the economists will always say, laissez-faire, let the free market rule and reign. We don't know how much mingling is really going into the market. And there's always small little comments stating that you'll know what the GDP number of China is next year because they've already printed it. But those are all tongue-in-cheek comments. And yes, I think global diversification is a key element. I think with Trump coming in, as Sasha mentioned, there will be a lot of policy changes within the first 100 days of him being in. I don't think him being who he is, I don't think anybody really knows. The S&P 500 is near all-time highs again today, as you pointed out earlier. Yeah, but again, don't focus your portfolio on one specific geographic area. Diversify across and maintain that position for the year ahead. And with the currency valuations going into offshore investment, it's maybe good to first build up some bulk and then do it in phases over time, then calling the spot exchange rates that we see the volatility through. It is making it quite difficult to manage portfolios, as you can well imagine. I can
only imagine, but at least it's been fairly quiet through the December period. Well, we touched on offshore exposure, and I want to pick up on Europe, given the fact that they are looking to tighten slightly on the quantitative easing policy that they have there.
So I think that's definitely a card, and that will move through into the economics. But key factors to look at there is, I know Germany and France are heading to the election and to the polls soon, or halfway through the year. Again, seeing what we saw in 2016, it's been extreme, or maybe the populations or the world telling their leaders, listen, we want change, even if it's for the worse, but we want change. It can't go on the same. So will Germany and France face the same situation? It's very interesting, and I think those being the leaders of the European region, without the UK obviously moving out now, and when Article 51, I think it's called, will be served, I think hang off Europe for a while. I don't think it's hit rock bottom, but again, it's not about timing the market, it's time in the market. So maybe put a small amount in the European region now and phase it in over time. Rand cost averaging or investment averaging over the time would definitely benefit any portfolio at this point in time.
Exactly. I want us to go back to the various asset classes, as we've touched on equities, and maybe point to property, bonds, as well as cash, and maybe focus a little bit more on bonds for the moment. I see over 10 years that's brought about an 8% return on investment. So clearly also a market which is performing significantly well, but we saw how volatile that was just last year as well.
Some people refer to it as hot money because it's quickly to come in by foreigners, but it's also quickly to go offshore, because they're just looking for the best yield. One of the asset managers told me about an acronym. It's called TINA, and that sounds like a pretty girl, but it's actually, there is no alternative.
Yes.
So one of our asset management members went over to the US, and he said that they don't even know who our president is. They just want the yield. So, I mean, sometimes we start focusing on these nitty-gritty South African problems instead of standing back and looking at the macro field. Investors will go where yield is. So as long as that maintains its position, I think, well, we've seen bonds have been sold off quite a bit at the end of the last year, but there is still scope for movement.